Easy Forex presents Top 5 Trading Fails, sorted by time. We all dream of making that killer trade, but some trades really have been true killers, costing billions of dollars. Here are some of the traders that have gone down in history as making some of the worst investments ever. Brian Hunter. Brian Hunter worked for Amaranth Advisors, a U.S. hedge fund. Hunter had been betting on natural gas futures, and he scored a big win when Hurricane Katrina had a huge impact on natural gas infrastructure along the U.S. Gulf Coast. The profits that he made, around $800 million, created excitement in the markets and attracted a large number of investors to the hedge fund. Then, while he was still holding a long position, the market turned on September 14, 2006. Hunter and his colleagues alone lost a staggering $560 million. However, the overall impact was much larger. Total losses came in at about $6.5 billion and led to the closure of the hedge fund. Kerviel worked for the Société Générale, a French multinational banking group with its headquarters in Paris. He had been at the bank for several years and had an intimate understanding of how trades were approved and monitored. He engaged in a series of unauthorized, speculative trades on futures in Europe between 2006 and 2008. While he made early gains, he concealed his activity by creating imaginary trades, which offset his wins in the bank's computer systems. However, chaos broke out when managers at the bank found out that Kerviel had made tens of billions of dollars in fraudulent trades. They closed out his positions, but took an enormous loss because the market was falling at the time. Overall, the rogue trader lost the bank $7.1 billion, although he made no personal profits from the trades. John Merriweather. Merriweather was a trader at the Long-Term Capital Management hedge fund. He engaged in a number of risky trades in Russian bonds in 1998. The leverage he used was so enormous, 100 to 1, that his positions put the entire global financial market at risk. A financial crisis in Russia resulted in the fund losing $4.8 billion within a few months. The situation was so bad that the New York Fed recruited a number of Wall Street banks to bail out the hedge fund in order to protect the global economy. Sean Quinn. Quinn was the chairman of Quinn Group, a self-made mogul. He acquired 25% stake in Anglo-Irish Bank, using funds from his insurance business to fund the purchases while the bank's shares were rising sharply. Then, the global financial crisis led to a sharp decline in the bank's stock price, forcing Quinn to reduce his exposure to the company. By the time the smoke cleared, the Irish government had to nationalize the bank at a cost of over $30 billion to Irish taxpayers. Quinn personally lost $3.2 billion and went bankrupt. Nick Leeson. Leeson worked at Barings Bank. He got himself into trouble by making a number of poor trades in 1995, and then tried to recover his position by placing a short straddle on the Nikkei index, essentially betting that the Japanese stock market would not see a huge overnight move. The very next day, an earthquake struck Kobe, sending the Nikkei index into a slide. Leeson then doubled down, making large bets that the index would recover quickly. It didn't, and Barings lost $1.4 billion, causing Britain's oldest bank to go out of business. You were listening to a Easy Forex production. Choose to trade anytime, anywhere. Web, mobile, options, trade desk, and MT4 platforms. Start trading now. easy-forex.com